Have you ever wondered how to start investing in stocks? Well, you're not alone. It's a question that has crossed the minds of many. So, let's dive right in. Stocks represent shares of ownership in a corporation, giving you a claim on part of the company's earnings and assets. They are one of the most popular investment avenues and play a significant role in building a diversified investment portfolio. Why so? Because stocks have the potential for substantial long-term growth. But as with all investments, along with the potential for high returns, there's also a degree of risk involved. This risk comes from market volatility, which can cause the value of stocks to fluctuate over time. The allure of becoming a shareholder in a company, coupled with the potential for financial gain, makes investing in stocks an exciting venture. But remember, understanding what stocks are and the risks involved is the first step to becoming a successful investor. Before diving into the stock market, identify your financial goals. This is the first and most crucial step in your investment journey. Establishing clear, achievable financial goals isn't just about knowing how much money you want to make. It's about understanding what you're investing for. Are you looking to retire early? Maybe you're saving for a down payment on a house. Or perhaps you're hoping to start your own business. Each of these goals requires a different investment strategy. For example, if you're looking to retire, you might opt for a more conservative approach, investing in low-risk stocks and bonds. On the other hand, if you're saving for a house, you might be willing to take on more risk for the chance at higher returns. Or if you're hoping to start a business, you might look into investing in growth stocks or mutual funds. Having clear financial goals in mind will guide your investment decisions. So take the time to really think about what you want your money to do for you. Now that you have your goals, it's time to choose the right investment account. Picture this. You're at a buffet and there's a smorgasbord of investment accounts laid out in front of you. You've got your individual retirement accounts or IRAs, your 401ks, and your taxable brokerage accounts. Each has its own flavor and serves its own purpose. An IRA, for instance, is like your classic comfort food. It offers potential tax advantages and is a great way to save for retirement. But there are contribution limits to keep in mind, and early withdrawal can lead to penalties. Then you have the 401k, the hearty main dish. It's usually offered through your employer, and contributions are often matched, meaning free money. But again, there are limits and penalties for early withdrawal. Finally, there's the taxable brokerage account. The dessert, if you will. It offers the most flexibility, but with that comes taxes on any gains you make. Choosing the right investment account is crucial to maximizing your potential returns. So, choose wisely. Before buying your first stock, grasp the basics of the stock market. The stock market is a marketplace where buyers and sellers trade shares of public companies. Each share represents a piece of ownership in a company. When you buy a share, you're essentially buying a small part of that company. Shares are bought and sold through market orders and limit orders. A market order is a request to buy or sell a stock immediately at the best available current price, while a limit order is a request to buy or sell a stock at a specific price or better. For instance, if you place a market order to buy a share of company A, the transaction will take place instantly at the current market price. On the contrary, if you place a limit order to buy the share at $20, the order will only execute when the stock's price drops to $20 or below. Remember, the price of a stock is influenced by supply and demand, much like any other product. If a lot of investors want to buy a stock, high demand, and few want to sell, low supply, the price will go up. Conversely, if many investors want to sell a stock, high supply, and few want to buy, low demand, the price will go down. Investing in the stock market isn't about making quick, risky decisions. It's about researching and understanding the companies you're investing in. You should understand their business model, their financial health, and their potential for future growth. Look at the company's revenue, earnings, future growth plans, and the competence of its management team. Read their financial statements, listen to their earnings calls, and keep up with news about the company and its industry. This research will provide you with a wealth of information to help you make informed investment decisions. In the end, understanding the stock market basics is not just about knowing how to buy and sell shares. It's about understanding the factors that influence stock prices and the importance of thorough research. Understanding the stock market basics will help you make informed investment decisions. Diversification is a key strategy in managing investment risk. But what exactly is diversification? It's like not putting all your eggs in one basket. In the world of investing, this means spreading your investments across various sectors and types of stocks. Why is that important? Well, imagine if you invest solely in one sector, say technology, and then that sector experiences a downturn. Your entire portfolio would suffer, but if your investments are diversified, a downturn in one sector or type of stock might be offset by stability or gains in another. This is the power of diversification. Now, diversification does not guarantee profits or protect against all losses, but it can help spread risk, and in the unpredictable world of stock investing, managing risk is crucial. So, consider a mix of different types of stocks and sectors. Diversify to protect your investments. Diversification can help protect your investments from market volatility. Now that you have a basic understanding of how to start investing in stocks, what's next? Let's quickly recap the key steps we've covered today. First, we talked about the importance of setting clear financial goals. Remember, knowing what you're aiming for is crucial. Next, we discussed selecting the right investment account. It's all about finding the one that fits your needs. Then, we dove into the basics of the stock market. Understanding how it operates is essential. We also highlighted the importance of diversification and risk management. Spreading your investments can help mitigate potential losses. Don't stop here. Continue learning about stock investing. There's always more to discover. Start small, get a feel for it. As you gain confidence and experience, gradually increase your investments. Investing in stocks can be a rewarding journey. Remember, the key to successful investing is knowledge, patience, and discipline. Stay focused, stay committed, and you're on your way to financial growth.